Today, record broken after a 25% round trip. Hello again, it's Martin Hill from Digital Finance Analytics World Latest Post, covering finance and property news, and this is our weekly market update. Well, another volatile week, the S&P 500 posted a record high close on Friday of 4,839 for the first time in 2 years, erasing the last of a nearly 25% drop between the record high close of 4,796 on January the 3rd, 2022, and its low in October 2022. The S&P 500 has been in a bull market since it closed at that low in October. Now, it's been fueled, of course, by a rally in chipmakers and other heavyweight technology stocks on optimism around artificial intelligence. So the drive has been narrowly based. And the Dow Jones Industrial Average, which also hit a record close high on Friday, confirmed that on December the 13th, it had reached a bull market since September the 30th, 2022. And meanwhile, the Nasdaq composite recovered 43% in 2023. It would still need to rise another 4.8% to return to its record high close of 16,057. That was reached on November the 19th, 2021. Anyway, on Friday, the S&P 500 jumped 1.23%. The Nasdaq jumped 1.7%, while the Dow Jones Industrial Average rose 1.05%. Looking at specific names, Nvidia climbed 4.2%, and Advanced Micro Devices rallied over 7% after server maker Super Microcomputer lifted its second quarter profit forecast, sending its shares soaring 36%. Investors exchanged $31 billion worth of Nvidia stock and $23 billion worth of AMD shares, higher turnover than any other company on Wall Street. The Philadelphia SE Semiconductor Index soared 4% to a record high, while the S&P 500 Information Technology Sector Index jumped more than 2% to, you've guessed it, a record high. Microsoft and Apple, the world's two most valuable companies, both rose more than 1%. And chipmaker stocks have gained since Taiwan Semiconductor Manufacturing Company, the world's largest contract chipmaker, on Wednesday said that it saw booming demand for high-end chips used in AI. And elsewhere, the University of Michigan on Friday reported its index of consumer sentiment soared to 78.8 in January from 69.7 in December. Over the last 2 months, sentiment has climbed a cumulative 29%, the largest 2-month increase since 1991, it also said. In addition, the survey found that year-ahead inflation expectations softened to 2.9% after plunging in December. The current reading is the lowest since December 2020 and is now within the 2 to 3% range that it's been in the 2 years prior to the pandemic. So what's ahead for the markets? It's a good question. Well, in his latest Flow Show note, published on January 18th, Bank of America strategist Michael Harnett said there's one simple focus across asset classes: the US Federal Reserve. The bank's January Global Fund Manager Survey found that the most important driver of markets this year is the Fed, according to 68% of bond investors and 52% of equity investors. In addition, 49% of currency investors pointed to rate differentials. Mr. Harnett wrote, "The market is very Fed dependent. Meanwhile, the Fed is data dependent and the data is, well, ambiguously strong." He pointed to initial unemployment claims, which indicated the Fed should hike rates, while purchasing manager data and small business conditions say the opposite. Despite rising optimism, Joseph Kalish, chief global macro strategist at Ned Davis Research, said he thinks markets are betting too heavily on a March rate cut. The Fed hasn't won the war on inflation, but seems to have won the battle of inflation expectations, he said. But other strategists and economists argue that the door for March is, well, wide open for a cut. Interest rate traders now see a 52% chance of a March rate cut, according to FedWatch. And the 10-year bond yield was at 4.127, and the 2-year at 4.389, both slightly up. Ahead, the S&P 500 could lose steam if companies reporting quarterly results over the next few weeks fail to justify relatively high valuations. Watch especially for Netflix, which reports on Tuesday, and Tesla reporting on Wednesday. This new record level of the S&P 500 is sustainable only as long as earnings meet expectations, said Steve Sosnick, Chief Strategist at Interactive Brokers. If, on the other hand, we find out that the market has either gotten ahead of itself or we get guidance from some of those companies that doesn't match the bullish sentiment that's been priced in them, that could be a real risk. Morgan Stanley economists suggest that recent Fed communications have emphasized quantitative tightening, anticipating discussions in upcoming meetings leading to a June start for tapering. That's earlier than initially expected. However, the market's anticipation of the imminent end of QT is deemed exaggerated. The earlier taper initiative is expected to be coupled with a more gradual reduction. The Fed will start discussing tapering QT soon, but will not end QT soon, analysts at Morgan Stanley said. Although markets will pay close attention to the Fed's balance sheet, we see the implications for fixed income markets as limited, the analyst said. One key misconception is that QT necessarily means destruction in bank deposits. Indeed, over the past couple of quarters, as the Fed's balance sheet has contracted, deposits have moved mostly sideways, but also are actually up slightly, they concluded. Real estate investment trusts, REITs, were among the worst performing sectors over the past year, with share prices weighed down by factors ranging from high interest rates through to tepid demand for office space in an era of remote working. The real estate sector of the S&P 500 fell 3.4% in 2023, while the broad S&P 500 index soared more than 24% last year and hit a record high on Friday, as we said. Real estate pain has continued into 2024, pushing the sector down 3.4% in January, against a 1.4% gain for the S&P 500. Yet, some investors are growing more confident that the trend will reverse, especially if the Fed cuts rates as aggressively as many investors expect. REITs benefit from lower rates, which reduce the cost of capital and fuel revenue growth. REITs were crushed by the fastest rate hiking cycle in 40 years and are going to move in line with expectations of rate cuts, said a research analyst at Gabrielli Funds, who remains bullish on REITs such as American Tower. Investors have been wading back into the sector. Global fund managers increased their exposure to REITs by 15 percentage points in December, pushing allocations to 12-month highs, according to the latest survey from Bank of America. Historically, the end of a Fed hiking cycle has been supportive of REITs. Since 1995, public REITs have gained 20.1% in the year following the last rate increase of a cycle, according to data from Center Square Investment Management. The S&P 500, meanwhile, gained an average of 10% in the 12 months after the Fed finished the last rate hike since 1980, according to data from Putnam Investments. Investors will get readings on the pace of inflation and the economy next week, with manufacturing PMI data released on Thursday and personal consumption expenditures data released on Friday, in addition to earnings from 3M, United Airlines, and Abbott Laboratories. Now, oil prices settled slightly lower on Friday, but recorded a weekly gain as Middle East tensions and disruptions to oil output offset concerns about the Chinese and global economies. Brent futures settled at $78.71 a barrel, and US West Texas Intermediate crude fell to $73.45. For the week, Brent gained about 0.5%, while the US benchmark rose about 1%. In China, slower than expected economic growth in the fourth quarter raised doubts about forecasts that demand will drive global oil growth in 2024. In the US, about 30% of oil output in North Dakota, the country's third largest production state, remains shut due to extreme cold, according to the state's pipeline authority. Supply disruptions remain an upside risk, but there are downside risks too, including global economy, Craig Erlam, analyst at broker Anya, said. Money managers cut their net long US crude futures and options positions in the week to January the 16th, according to the US Commodity Future Trading Commission. European shares logged weekly declines on Friday as investors tempered their expectations around major central banks reducing borrowing costs this year, with the focus now squarely on the European Central Bank's next policy meeting. The Pan-European Stock 600 index ended 0.3% lower after rising as much as 0.5% through the day. The benchmark index clocked a decline of 1.6% this week after hawkish remarks from ECB policymakers prompted traders to rethink expectations for interest rate cuts. The DAX index in Germany traded slightly lower, as did the CAC 40 in France, while the FTSE 100 in London slid slightly too. The main European indices are still beset by weekly losses on growing doubts that major central banks and the Federal Reserve in particular will agree to early interest rate cuts as inflation, remains sticky. We should take the jitteriness that we've seen over the course of the last few weeks in the context of the rally that we had through the course of 2023, said the global investment strategist at JP Morgan Private Bank. Perhaps markets just got a little bit too ahead of themselves in terms of pricing those interest rate cuts. So what we're looking at now is just some consolidation after a really strong rally. And again, rate-sensitive real estate was the worst performing sector this week, followed closely by basic resources. For the day, basic resources led declines down 1.4%, while industrial goods and services fell 0.9% as Swiss engineering group ABB dropped 3.7% after document shows its operations in China are being scrutinized by 2 US Congress committees. Focus will now shift to the ECB's upcoming policy meeting on January the 25th, where the central bank is broadly expected to keep rates steady, though comments from its officials about its rate outlook will be scrutinized. JP Morgan brought forward its first rate cut expectations by the ECB to June from September, but it remained cautious about inflation and wages growth. And on the data front, German producer prices fell more than expected in December, decreasing 8.6% year over year. And British retail sales suffered the biggest drop in almost 3 years during December, falling 3.2%, raising the risk that the economy entered a recession in the fourth quarter. UK consumer prices, by the way, also rose to 4% on an annualized basis in December, and that's the first increase in 10 months. Among major movers, Teleperformance gained 8.6% after Stifel upgraded the teleservices firm to buy from hold. And elsewhere, gold futures rose 0.5% to 2,031.90, while the euro US dollar traded largely up to 1.0897. Now in Asia, most Asian stocks rose on Friday as the positive AI-fueled outlook from TSMC spurred a rebound in the technology sector, although weaknesses in China and uncertainty over interest rates still hang large. Japan's Nikkei 225 was the best regional performer for the day, up 1.42%, and once again coming in sight of a 34-year high. The index, along with the broader topics, remained an outlier among its peers, though, and is headed for a 1.3% gain this week. Data on Friday showed Japanese consumer price indices fell as expected in December, setting the stage for an ultra-dovish Bank of Japan when it meets next week. And broader Asian technology stocks also clocked strong gains on Friday, tracking a positive forecast from TSMC, the world's largest contract chipmaker. TSMC rose over 5% in Taiwan trade to a near 2-year high after the firm said it was well positioned to capitalize on a boom in artificial intelligence development over the coming year. And the chip maker also clocked a smaller than expected decline in its fourth quarter earnings, citing increased demand for its most advanced chips. TSMC's positive outlook spurred increased optimism that a boom in AI will help spur renewed investment in the tech sector, which was reeling from a nearly 2-year slump amid high interest rates and stagnating demand for electronics. Gains in TSMC spilled out into other Asian markets, with the South Korea Kospi adding 1.1% on strength in chip makers, Samsung Electronics and SK Hynix. Gains in heavyweight tech stocks helped Hong Kong's Hang Seng index, but it still fell 0.5%. That was the worst performer in the region, down about 4.5% across the week, tracking steep declines in mainland stocks. The gauge of mainland firms listed in Hong Kong languished at the bottom of the global equity indices ratings for the year so far. China's Shanghai Shang-Seng CSI 300 and Shanghai Composite indices lagged their peers for the day after rebounding from multi-year lows in the prior session. The two indices were heading for a third straight week in the red following disappointing economic figures for the fourth quarter. Grim milestones have been set and piled up in recent days. Tokyo has overtaken Shanghai as Asia's biggest equity market, while India's valuation premium over China has hit a record. Locally, a meltdown in Chinese shares is wreaking havoc on the nation's asset management industry, pushing mutual fund closures to a 5-year high. And Moody's on Friday downgraded China Hurong Asset Management Co. to junk status over concerns about the property crisis. The Hang Seng China Enterprise Index has already lost 11% in 2024. Coming after a record 4-year losing streak, the slump is reinforcing a structural shift that's seeing everyone from active money managers to passive funds turn their back on the world's second largest stock market. The Nasdaq Golden Dragon China Index slipped as much as 2.2% at the start of US trading on Friday, extending losses to a 5th consecutive day. So all in all, some $6.3 trillion worth has been wiped out from the market valuation of Chinese and Hong Kong stocks since a peak that it reached in 2021, underscoring the challenge that Beijing faces as it seeks to arrest a decline in investor confidence. Authorities have ruled out the use of massive stimulus to revive the flagging economy, leaving traders wondering when things will improve. What we're seeing this year so far is really a continuation of what we saw last year, said John Lin, AllianceBernstein's chief investment officer of Chinese equities. These squeezing the toothpaste type of stimulus policies so far haven't been able to turn around the underlying bottom-up fundamentals of areas like the property sector, he said on Bloomberg. The headwinds buffeting the market are well documented. China's real estate sector remains in trouble. Deflationary pressures are building, and the long-running feud between Beijing and Washington refuses to go away, with the US elections set to take place later this year. And in recent days, uncertainties about the trajectory of US interest rates and the threat of an imminent blowout of local stock derivatives have added to investor worries. Asian fund managers have cut their allocation to China by 12 percentage points to a net 20% underweight. That's the lowest in more than a year, according to the latest Bank of America survey. And managers of benchmark tracking funds have sold a net $300 million worth of shares traded in mainland China and Hong Kong this month, according to a Morgan Stanley note. That's a reversal from the last half of 2023, when they bought $700 million worth on a net basis, even as stock indices declined. China is a waiting game, and we continue to be waiting, said Mark Matthews, head of Asia research at Bank Julius Baer & Co., which is mostly avoiding Chinese equities. Beijing's efforts to reassure investors have been met with skepticism from investors, many of whom worry that authorities are behind the curve. And while the People's Bank of China took steps last month to pump cash into the financial system, it bucked widespread expectations for cutting a key policy rate on Monday. In contrast, India's Nifty 50 index, which is held by local tech stocks, still remains strong and was last at 21,575. Now, Australian shares jumped on Friday, snapping a 4-day losing streak after the solid US labour data report bolstered optimism about the economy. And that, of course, sent Wall Street and risk assets into the green. The ASX 200 closed 1.02% higher at 7,421, having pulled away from Thursday's one-month low, and the All Ords gained 1% to 7,652. For the week, however, the main indices were down 1% and finished the session well under a peak of 7,632 touched on January the 2nd. 10 out of the 11 sectors notched gains, with tech the big winner, up 3%. Zip rose 11.42% to 64 cents. EML payments jumped nearly 10% to $1, and Xero shot up 4.8% to 114.73. Investors also favoured the resources stocks after a rebound in commodity prices on hopes that top consumer China would announce stimulus measures to support a slowing economy. Heavyweight miners Rio Tinto gained 0.9% to $128, and Fortescue rose 2% to $27.58. BHP closed flat at $45.73. Yet uranium miners were given a wide berth with Boss Energy and Paladin Energy among the biggest laggards in the session, down more than 2% each after strong rallies earlier in the week. The big banks advanced with ANZ up 1.32% at 26.13, CBA up 0.71% to 113.28, NAB 1.26% higher at 31.28, and Westpac 1.53% up to 23.20. Macquarie was also up 1.46% to 183.28. And in corporate news, Whitehaven was among the top performers, up 3.8% to $8.11 after the mining company retained its full-year coal production guidance despite geological challenges, reducing output at the Nuremberg mine and a major train derailment in December. The increase in production for the sector has reflected more robust global conditions versus expectations, said George Barbaras, head of research at K2 Asset Management. Whitehaven's strong performance from their open-cut mines, combined with the potential part sale of Blackwater, would deliver some working capital to invest in additional growth assets. Rival coal miner Yancoal closed up 5% to $5.52, the highest level since September, and New Hope jumped 2.9% to $5.32. The good news is that it looks to be a better year in 2024 for coal miners broadly, especially with demand set to rise from regions such as India and China, said Josh Gilbert, a market analyst at eToro. Meanwhile, biotech Mesoblast leapt 13.2% to 30 cents after the US Food and Drug Administration approved a designated treatment for a rare pediatric disease. And the Aussie was last at 65.97 to the US dollar, and 51.94 against the UK pound, both easing back from recent highs as yields on bonds moved a little higher. And finally in crypto, after the break of the ETF dam, Bitcoin was last at around 41,600, off from recent highs, and I guess is looking for direction now. So standing back, we are once again at highs on the US markets, driven by that narrow sector of AI, and the question of what the Fed will do. So in a way, little has changed. The volatility that we've been seeing will continue. Markets probably will go a little higher, but some of those fundamentals still look dodgy to me. We will wait and see. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.